All right, welcome back, everybody. Today we are lucky to be joined by Lawrence Roulston. I've known Lawrence now for a couple of years now. We've chatted a lot about the metals industry. Haven't known him for the more than 25 years of hands-on experience he has in the resource industry. Lawrence really has been all around the world and seen properties in every continent that you can imagine. He is the editor of Resource Opportunities, a well-renowned, world-renowned actually, newsletter based on the commodities industry. Today, Lawrence and I are going to quickly touch on the fact that the election is over and there are more important issues out there that really the world started to see again today with the fall in really every stock market in the U.S. Lawrence, what's your opinion here when we were just talking about these the ongoing depreciation in currency values around the world?
Well, it's very clear now, and especially with Obama back in the White House, that there's not going to be a serious effort to reduce the deficit, that the annual budget deficit, let alone do anything to bring down the overall $16 trillion of debt and the massive unfunded liabilities that the U.S. is facing right now. And the only way out of this for the U.S. is a continuation of the depreciation in the currency value. But, of course, the dollar is measured against the euro, and the euro is in even worse shape. And therefore, people aren't really going to notice the declining value of the dollar because the euro is going to be falling slightly less or slightly more quickly. So it all comes back to, with debts in the U.S. and debts in Europe getting bigger and bigger and bigger, that the values of the currency are going to continue to decline. And so I really want to emphasize hard assets as a way to protect yourself against declining values of the currencies.
Well, it's actually been quite interesting how when we've seen this devaluing of the currencies for essentially the last 4, 8, almost 10 years now, we've just seen the gold price and even the silver price, the chart for that, just on an upward trend, just skyrocketing, really, where the old adage says that gold and silver and a lot of the metals are really a hedge against inflation, which they've proven to be, correct?
Well, absolutely. The gold price, as measured in U.S. dollar terms, is 6 times higher now than it was at its low in 2001. The silver price is up by the same 6-fold ratio. And it surprises a lot of people when I point this out, but the copper price is also up 6-fold from its low in 2001. So, whether it's gold, silver, or any of a number of other hard assets, you certainly want to have some exposure to hard assets that are going to effectively hold their value as currencies continue depreciation.
And see, another interesting thing that we were chatting about earlier is that while these currencies are going down, the money that is coming into the gold and silver market to really consume these metals isn't only coming from North America and Europe, where people are worried about their currencies. It's also coming from places like China.
Well, as a matter of fact, North America, for gold, silver, or any of the other metals, is really way down the list of priorities in terms of the importance on the markets. The biggest consumer of gold for many, many years has been India. But China has now surpassed India as the largest consumer of gold. And China, by far, is the largest consumer right across the suite of base metals. So the emerging markets are much more intensive users of industrial metals because they're used more in the development stages of an economy than they are in the mature stages of an economy.
So are we seeing this big consumption of metals primarily for industrial purposes to build products or for investments?
Well, for gold and silver, obviously they're primarily for investments. For silver, in fact, the biggest use of silver is in industrial applications, and the investment realm for silver is only just starting to come back. But for the base metals, the investment component is really insignificant. The real value drivers for the base metals are industrial applications. And that includes consumer products, but it also includes infrastructure build-out. And so you look at China and India, massive infrastructure build-out, which is a huge consumer of metals. But also every emerging country in the world is using more and more metals for a whole range of things. You look at any of the emerging countries, consumers are just beginning the lifelong pursuit of things. And over here, most of us, our houses are so full of things that we can't really find the room to buy anymore. So the most important driving force in the metals markets are the emerging economies.
And they just keep on really consuming and consuming. But even the big economies like China, we hear that they're slowing down, but in the whole scheme of things, they really are still just consuming majority of these metals.
Well, let's go to your point about China slowing down, and that's one of these great, popular myths that's being, pushed by so many people in the media these days. China is not slowing down in any way, shape, or form. Instead of expanding by 9% a year, it's expanding by 7.5% a year. And even there, each year it's on a bigger base. So the actual increment of growth in China is still enormous. It is growing at a very fast pace, and already the largest consumer of metals by far, and continuing to grow. So it's absolutely the most important factor in the metals markets. And people lose track of things. They hear China slowing down and they think, why would I want to invest in a copper project or an iron project? But the reality is, even if there was no growth whatsoever in demand for metals, the mining industry constantly needs to replace existing productive capacity. And in fact, they need to replace about half the entire industry every decade just to stay flat. You think about a typical mine life being about 20 years, and the implication there is every decade, half the mining industry has to be replaced just to stay flat. And then you add on top of that the 2% plus compound growth in average long-term demand. And you can see there's huge demand for new metal mines, whether it's gold or silver or copper or tin or anything. And from my perspective, that's the really interesting aspect of investing, are looking at these little companies that are finding and developing the metal deposits that will become the mines for the major companies in years to come.
Yeah, very interesting, Lawrence. I think that's why we're both in this game, is that the thrill of finding that junior company that finds the next world-renowned discovery and really makes a go of it in this interesting economy that we're in.
Well, that's right. And, in spite of the kind of overall negative outlook on the mining industry and resources in general, two of the companies that we're following in the newsletter have takeover offers on the table in front of them at this moment. And both of them are effectively 100% over the trading prices prior to the offers coming out.
Wow. You have to be happy about that one.
Absolutely. And that's really, over the last 2 or 3 months, we've had about a dozen companies that are up between 50 and 200%, driven by the companies achieving milestones. 2 of them were these takeover offers, but others just achieving milestones that are adding value. So we don't need to see rising metal prices to score big if you select companies that are successful at achieving these milestones.
Well, okay. Well, there you have it, everybody. Thank you very much, Lawrence. If you want more information on what Lawrence's newsletter follows, check out resourceopportunities.com. We will also include a link down below on this podcast. Lawrence, we appreciate everything you said, and we're really looking forward to the future of mining and, gold going up.
Well, it's an exciting time.
All right, everybody. That is it.